focusing on the outliers, and like if they have these follow-on investment resources, they will distribute it accordingly so that their incentive is to get the return back of the fund. For example, 30 bets. So they're playing a hyper growth game, but then maybe you as a founder, you might want to focus on quality, or it's the technology that needs more time, but that's not the game the investor actually plays.
I think it's known that this question for spray and pray is not working on fundraising. You have to work the networks. There has to be warm introductions. You have to. It's still a people's game, and you have to be very careful when you go out in the marketplace. What label you put on your company when you raise money, etc. Be measured. It's always this that you have to find that nice balance of not over push it into the market because there might be an immune reaction back to you. But at the same token, get out of your chair and get into the market and find those investors which you want to go, because you're going to need them.
Welcome to Founder Real Talk, honest conversations about what it really takes to be a founder. And here we are live, another episode of Founder Real Talk. Today, I've got a special guest with me, Laurie Olivier. A warm welcome from my side here. And so I'm going to give a brief intro and then I play the ball over to you, Laurie. So as far as I know, you've been in the venturing world or venture capital world since the 80s. So that's quite a special perspective to have, because you've seen different cycles, you've seen some ups, you've seen some downs, you have seen different markets, you've been active in America, in East Asia, in Europe as well as Africa. And at the moment, as there's so much increasing interest about the African continent, with South Africa as the entry door, basically, I would like to kind of deep dive a bit into that. As well as usually on this podcast, we talk about the inner game. That's how I call it. But in order to understand the inner game, the other side is literally the external game. So how does venture capital actually works? What's the power law here? How does it work out so that the founders out there can actually learn and get insights what they're signing up for, if that's their game, how to play this game, how to actually become one of the few unicorns out there. So I'm quite interesting and very excited for this episode today. But before, I would like to learn a bit about your journey, as well as what you're most proud of, looking back in your journey of venturing in the last.
Well, so looking back, let's first just talk about my journey. So I'm South African, born and grew up actually on the northwest border of South Africa, on the Botswana border.
Mm-hmm.
Was not really exposed to technology. We never had electricity at home, at least been exposed to that at university, of course. Post-university, usual things. We had to do all military service. So I did electronics engineering and then later studied also commerce, law and data science, and then ventured into consulting for some years, then became part of the largest company in South Africa, Anglo-American Corporation, responsible for their non-mining new business, and of which venture capital and private equity was a key instrument of diversification. So you can argue been involved in corporate VC from the late 80s.
Mm-hmm.
At that stage, our first strides in corporate VC was actually in Israel at the time when the Israel market just got going into previously in Israel, it was the investment banks which did really the big transactions. That was in the late 70s, early 80s. And from there, been quite successful being part of the first, we can say the first two funds in Israel, Athena and Veritas. That was before the real explosion of venture capital in Israel, which happened in the 90s through the YOSMA program. I learned a lot about the transatlantic VC model there, which means technology in one continent and exits typically in another.
Mm-hmm.
And what are the issues if you want to develop a company with two legs, one leg in one continent, one in the other, and all the issues associated with that. Then started to become, being quite successful with that. Some funds out to venture capital and private equity in other markets, as well as you mentioned in East Asia, with typically Singapore as the sort of hub. and therefore been living through the nascent times there as well in terms of VC, investing in, from Indonesia right through to China. Then also involved in the, can I call it the early incarnations of venture capital in South Africa, which was in the sort of like 90s, sort of like, but it was very much a hybrid of some more lifestyle investments, I would say lifestyle company investments. And there was some technology in gaming and so forth, but typically it was not what you saw in the last decade, where there was a huge explosion since the founding of Silicon Cape, which my partners in 40i, Justin Stanford, was very much prominently involved with. I had the pleasure of also to be a speaker at the launch event, and ever since been involved in the growth of the venture in South Africa environment as well. And then, of course, we then started to also become involved in other African markets, typically more the Kenya ecosystem, a little bit Nigeria, and have not been that involved in activities in the northern tip of Africa, although we have some portfolio companies with a presence there.
Hmm.
But, that's still an environment which is sort of like almost the third layer for us at 40i Capital. So that gives you a little bit of a sense there. And at Anglo, just to complete the story, I had the privilege to join the industrial board of the group and the executive committee. That was in the early 90s, late 80s, early 90s. Therefore, have a lot of experience also in what we call intrapreneurship, so where we identified some innovations that was not driven by entrepreneurs in the sort of like the small startup environment, but much more where you have a corporate funded internal initiative. And I've been, took quite a lot of pleasure in getting some new products out there. It's, of course, a different world than the startup world. So from all areas of startups, all stages, and perhaps all regions. I think maybe I have to say I'm a master of none.
Jack of all trades. Is that the word? Yeah.
Yeah. Yeah,
Yeah.
indeed.
Yeah. Yeah. And you've also been a founder, right? And at the moment you're a partner at 40i Capital. Yeah.
Yeah, I guess I'm one of those going the opposite direction. Many times you find that people start as founders, become quite successful, and later become VCs and sort of like family office type people.
Yes.
I started from the corporate environment, moved as an LP into funds, and then later become a GP, and later become a founder. It was more or less when at the founding of 40i Capital, I've already been involved as an investor, an active investor in startups. And then we agreed that I would have sort of like an operating partner role and continue to being involved in these startups, which of course was a good thing for me because the 40i Capital team are all founders and entrepreneurs, and if you want to blend with that team, you have to understand that world because, and that's something which sets 40i apart, that we are being seen as probably the most founder-friendly VC in South Africa because all of us are just founders. And even today, I'm a founder. I'm living and experiencing daily the issues of a founder, which makes you listening to founders and to listening to the needs of startups in a different way, not purely through a financing lens and trying to optimize your investment in these companies, but to be truly helpful and meaningful in their sort of endeavors. And I think they do actually appreciate it when they talk to you. They will know you understand, or they will know maybe you're one of those investors which just want to protect your own interest.
Yeah. No, I mean, I talked to a founder yesterday one of the founders of mPost, and he was also telling me, like, in the beginning when they got their first investment 2010 here, there was literally no support, and the investors had no idea about the founder life because they were coming from a different angle. So it was super interesting to get that perspective. But yeah, obviously, like, especially in America, I think they're really strong with the operational support, right? Like that.
Yeah.
They even have teams who, support here hands-on, or have made these
Yeah, this
experiences themselves.
it's typically I mean, if you're in the more mature market, then you get these specializations,
Mm.
some funds here really develop a whole panel of recruiting experts and, having very specific areas of networks where they sort of like blend people into some of their networks. It becomes sometimes quite difficult in those environments because, for a founder, they have to navigate the business sometimes and also have to navigate the pressures or the direction, which sometimes can be overbearing coming from the investors. So it can be good, but it can also be, you have to have a very special and specific type of founder which blend into that. And I think therefore their selection criteria is very much on that to make sure it's almost as if you are somewhat of a corporate house and absorbing sort of like portfolio companies to become extensions or to become part of a group of companies as opposed to really independent, pulsing, sort of like individual companies.
Yeah. I would like to go deeper there a bit later, but first of all, I would like to ask you again, what are you most proud of when you're looking back in your journey? What you've built or what you have experienced? Is it like a certain moment or a certain something?
Well, it's always difficult for me to talk about what I'm most proud of. Perhaps I have to say I'm most proud of the wife which I chose when I married. But that
No,
being
but
set
that's
aside,
very valuable. Yeah.
yeah, I think it's always what one wants to look back is to say what are some of the legacy items which have been enabled through your very specific drive and which might not have been there if not in the same way or at the same time when if you have not been involved. And that's actually one of the entrepreneurship projects at Anglos where we worked on the evolution of a single blade wiper. Now it sounds strange, but it's highly technical. We actually had an entrepreneur coming to us from outside, which worked on the fuselages of missiles and had very specific understanding of the mechanical characteristics of metals.
Mm-hmm.
And, you might not be aware of it, but if you talk about up to even the late 80s or the early 90s, most wiper blades on cars had these sort of like arches, which make sure that the wiper blade is curved on the window as windows became more curved as models evolved. And the problem if you wipe at a high speed and you wipe over a surface where the curvature change with the wipe. Because if the wipe is down, it's fairly flat, and if it's up, it's fairly curved. And to make sure that it's actually do a clean wipe at very high wind speeds, at high sort of like rainfall, etc., it's quite a challenge. We with that company, a technology, with that entrepreneur, technology was involved whereby they tapered the wiper blade and both in terms of thickness and in terms of width and give it a very specific rolling profile. So the pressure on the, kind of call it the molecules in the metal was changed so that you could have a single and you don't have these ugly wiper blades anymore. So even today, initially we had the first models being furnished with those wiper blades were sports cars like Porsche and something like that. And later on, now it's on every car. You will just see a very neat, slim, and when I look at it and say, that was worth it. So that's at
Well,
least something which I can look back and say, well, I've not
yeah.
been the entrepreneur, unfortunately, or maybe fortunately, but I've been very much involved in enabling that
Mm.
project as the manager behind it at that time. So that's a
Yeah.
nice thing. I
Always
won't say
reminded.
that's
Yeah.
probably what's I'm the most proudest of, but
Yeah.
I feel
One
quite
of
good
us.
about it. Yeah.
Yeah. No, no, amazing. Yeah. Okay. Yeah. Then I would actually love to dive a bit into the South African market. I guess you mentioned before, like the Silicon Cape was like boosting it, in particular, like the South African venture capital market. And maybe you can share a bit of insights, like how it digitally evolved over time. I mean, in the beginning, last time you mentioned, it started also with corporate venture capital at first, like more from the banking side, if I recall it correctly. But maybe you can give some insights how, and especially how the game works now, and like what are the constraints here in this country.
Yeah. Yeah, so I think innovation in South Africa was first a little bit more corporate driven. Given the history of the South African industry with the major mining houses, which become financial houses and things like that. But actually, private equity really took off because of
Okay.
the strong financial orientation significantly in the 80s, 90s, 2000, particularly after the change in the South African political dispensation. There was a lot of requirements in terms of companies to have different profiles in terms of shareholders, and all the private equity companies really moved in big time into that. At the same token, of course, you had these different venture capital waves globally, and as these venture capital waves happen, some of there was some sort of reaction in South Africa as well. But most importantly, I think the Silicon Cape initiative did catalyze a major uptick in entrepreneurs taking a risk. Now, what I have to say is, because also with the political change in South Africa, you have found that many people could not find just comfortable corporate jobs anymore, and you had to go out and try other things. So there was different forces driving it. So there was enabling forces, and there was also, of course, kind of call it more pressurized forces, which actually caused, a uptick in entrepreneurs. So you have a lot of entrepreneurs, and of course, with the internet becoming available, and everyone can read online, and you can learn from what's happening in other parts of the world. Suddenly all of these were at the inflection at the same time, more or less at the end of the first decade of this millennium, sort of like 2009, 2010. You could really see that uptick there. Of course, some of my founder partners, or some of my 40i partners, were founders of companies earlier, but
Mm-hmm.
this is really when the wave picked up. And I think what what became also quite an important driver in South Africa is, at the time of the political change, there was an initiative formed by some of the corporates where they put some funds aside for small and medium enterprise growth. And then we had a fund called SASME, is South African SME Fund, become a sort of more of like a corporate, not a corporate, but a fund of funds, and start driving some of that funds, and really becoming a little bit equivalent to the YOSMA, but of course different, program in Israel, and seeded a lot of VC companies in South Africa. So suddenly you had a big uptick in VC money supply. You had a lot of entrepreneurs for different reasons adventuring and venturing into this, suddenly have all this sort of like information flowing to them through the internet and making them willing to try to risk. And South African people, by and large, and I've been involved in so many different markets, is very much willing to risk and willing to do diverse things and trying things which sometimes other people won't dare to try. So you have to be careful when you invest. But the bottom line is there is that sort of like general orientation to try things, and that really get going. And then of course, with more money supply, it's helpful. That also alongside it, just before that, there was a lot of angel investing, and that angel investing sort of like matured into this a little bit more of a VC environment. So I was a little bit worried because every two people with a dog call themselves a VC at that stage, and you have to be careful. But 40i played quite an instrumental role, I think, in bringing the Silicon Valley type structuring into the South Africa through being, I would like to say, the first VC fund which really adopted some of the pro forma template agreements which you saw on the NVCA, for instance. Although there was, of course, some elements. I recall when I was the chairman of a fund called MCA in 1995, we had Horizon Equity managing it, and we had some of those agreements. The manager there, which guy with the name of Richard Fett, came from Euroventures at that time, was 1995. And there was some of that structuring coming in. But I really feel 40i played a big role in bringing that into it. And then, of course, many other VCs, for different reasons, adopted the same approach. So it became very, very well structured. There were some legal firms which really became quite good at not only the fund agreements for VCs, the typical limited partnership funds, which is the norm for most venture capital companies, but also became quite specialized in the needs of entrepreneurs. So you have to have both sides represented. So you have the legal environment, you have the funding environment, you have the entrepreneurial supply. A lot of these things came together at the same time, and you saw a major surge of startups in South Africa over the past decade, certainly in the thousands. Which is good and bad. It's good that there's a good amount, but the bad part, probably we're going to talk, is that many of these first generation funds now are coming to the end of their life, and they have not necessarily provided a lot of liquid returns to their LPs, their sort of institutional investors. So there's a little bit of a downward curve. You can see it in all norms in terms of these funds available. Many of these now thousands of companies need to exit in the next 3 to 5 years, because those funds need to come to the end of their life, and they have to either liquidate their holding or distribute paper up to their institutional investors. So I think we're in for a very interesting few next years, which I saw the same happening in some of the other nascent markets, although a little bit different in the sense that, for instance, in Israel's environment, Israel was very much almost like just another state of the US when you look at how they engage, because they were so integrated in terms of the US environment. Most of the good Israeli exits were on NASDAQ, and so it was very integrated. So you didn't see the same amount of structural stress, which I do anticipate you will actually see in Africa and South Africa in the next 5 years, in terms of adopting or changing to a new equilibrium from where it were.
Can you maybe explain for the founders, the listeners, like how the game is structured from like an investor perspective? So like how the fund, like just briefly to explain like the power law, basically, like how, for example, now that, usually like the fund is structured in 10 years, and like how they then do follow-up investments, or what incentives they actually have, so that the founder nowadays can understand like what's actually happening here.
And so there's some power laws, and there's some really interesting insights which one can have when you think of how VCs operate. So you have to think about that as well. So if you talk about VCs, typically, as we know, it's a 10 plus 2. So you have 10 years of fund life. And then if you have not exited, which most VCs in Africa have exited the entire portfolios after 10 years, you then have the ability to have typically 2 1-year extensions. Then thereafter, typically what happens is, if it depends on how the fund structure is, if you have many LPs, there's some LPs want to say, listen, all right, we're still willing to hang in, whereas other LPs say, no, we want to get out. And then you form either continuation vehicles or annex funds, which is typically a little bit almost like what happened in a startup. It's a little bit like a preferential fund where you say, listen, all right, a couple of LPs are willing to keep funding the portfolio, but they will then get a preferred return before all the other LPs, the other institutional investors in the fund. It's a little bit like on a portfolio company where you have sometimes there's later rounds where there's a little bit of a preferential position in the waterfall to the earlier ones. You get that actually on the fund level as well. which founders needs to take note of, because there are those pressures which these venture capital people have to manage also with their LPs. And then there's the other thing. If you want to continue to raise your next fund, you have tremendous pressure on yourself to put some returns back to your LPs, called DPI, back to and it sometimes makes you becoming quite disruptive on the board of a startup, because now the startup manage all these things. They have to worry about valuations. They have to worry to show a certain sort of like continuous path. And here comes someone willing to sell their shares at a significant discount. Now, what now? You change the valuation of the company, and is the real value now the value of this latest deal, or is it not? How do you manage that perception? Because now if you then go out to raise new primary money, people will ask, so what was your last round valuation? And it could be a valuation which was totally artificial because of that structure. So those are some of the tensions. And then the other thing, you also find that there's a learning curve with the VCs. And this, I sometimes say that, sometimes they are managed by fear. They're managed by the fear of losing their investment. And therefore, some of these guys which have not really understand that these difficult times come, but you go through them and they pass. You always have to reserve dry powder. You should never be starry-eyed and invest all your money. Maybe I just have to say that typically a 10-year fund have what we call an investment period, which is the period in which you can make new investments. Then there are these only follow-on investments, and that investment period, as you know, is typically 4 or 5 years. And then there are another 5, 6 years are then the sort of like the follow-on. Now, there's always a question: how much money do you have to reserve for the follow-ons? And then you always have the struggle. The VC is that if you are investing in these companies, when do you have to say, I have just no more, I have to get out of this, because it's quite difficult. And then there's a different dynamic for the entrepreneurs, because let's say if it's one of your leading VCs and suddenly they can't do follow-ons, there's two major implications. The one major implication is typically that when a new investor come in, they would like to see the validation by the old investors. And if the leading investors are not putting more money in, they read it as a sign of no confidence. And therefore, it can be quite difficult on those portfolio companies. That is, can be a significant problem when a fund cannot just continue to invest. But also, then there's also another set of concerns. You have this company might have to go through a restructure, a reset, or whatever, who knows, and therefore, which will cause the older investors to be somewhat impaired. They will be pushed back on the waterfall. They will not have the great terms of the later investors. And when it comes to the approval of those rounds, then you find it's difficult, because now these guys don't want to approve a round where they will now take back seat and someone else take front seat. So suddenly that dynamics between the shareholders, the board, the founders, all of those become quite, cavalierish. That's the best way of saying it. And if you have not been an entrepreneur which understands this, or if you don't have at least one of those managers close to you so that they could calm you down and say, don't worry, let's just sit this thing out and don't do stupid things and so forth. It can be, it can be quite a volatile period, white waters period in the river, if I may call it that way. So yes, I think this dynamic of VCs is a very important thing for founders, Jana.
Yeah. I mean, even to understand, like if an investor has like 25, 20, 30 startups in a portfolio, that they're focusing on the outliers, and like if they have these follow-on investment resources, they will distribute it accordingly so that their incentive is to get the return back of the fund. for example, 30 bets. So they're playing a hyper growth game in that kind of a sense. But then maybe you, as a founder, you might want to focus on quality, or it's the technology that needs more time, but that's not the game the investor actually plays, which is quite interesting, because sometimes like the incentives can be crashing in a way. Like even yesterday, I talked to a founder where he said, yes, the investor wanted to see growth, but then they were like, okay, yes, they can, expand. For example, that's probably also something special about South Africa. There is only a certain amount, like to expand like vertically, because the market is limited. So you can spread out horizontally, but then you're not in your core business. So you deliver some like additional product services or whatsoever, or you can go into other markets to maybe meet that growth. But is that really what you wanted to do with your business? Because that's again, like there's a different incentive from both sides, but you really need to understand what the investor game is. So you understand where does the money come from, and like, yeah, how is it played in that kind of a sense? Yeah.
So, an interesting comment on that, Jana. So, if you think of the 40i portfolio, there's typically, or let's say South African portfolio, there's typically two types of company startups. One is where you invest something which have a real fill a gap in the local market, and let's say in the development economies, or the emerging economies or countries like Africa or maybe South America, India, etc. And then you have those companies which focus on technologies which are really world leading, and they are just playing in the world game. So it's not a emerging game. Now, this, for instance, if you talk about the impact funds in Africa, they would not care so much about these startups which actually have products which just conquer the world. They want to see something which have an impact on, some of the social requirements of their funds, etc. So sometimes entrepreneurs have to navigate those things as well, that they have VCs which have different mandates when they invest and different expectations from that. And you've just mentioned here, for instance, then you could argue if you're in a more limited market, so you don't work in the global market, now you have the pressure, maybe you have to diversify your product, or you have to sort of diversify your region. And I think that's where many people, founders, are really running into difficulty, because if you look at how sometimes troublesome it is to take a investment through different countries in Africa and navigate all those country specific issues, even though
Yeah.
you know exactly your game, it can just be a killer. And you have to decide how do you focus. Just like that, if you talk about these companies which have this international plans, so now you
Mm.
have to set up an international presence.
Yeah.
And suddenly, I mean, you pay a business development person maybe, let's say, 100,000, which is how many dollars divided by 17, it's sort of like $6,000, $7,000 in South Africa. Suddenly you have to know that if you have that same person in the US, you're going to pay 20,000 plus a month
Mm.
dollars. And then, a salesperson is what a salesperson is. They are good salespeople. And
Yeah.
if you don't understand that environment, that person is selling you, the founder. And you end up with the belief that this is the most wonderful person which you can think of, just because in America, people are trained to sell. And then
Mm-hmm.
after 6 to 12 months, you just start seeing the person is still getting the salary, but there's no good real progress. But if you have the sales meeting, it sounds dramatic, but there's
Mm-hmm.
not much that's happening there. So the challenges and the cost and the risk of going from local to global is big. Just like the
Mm.
challenges for, even in the emerging markets, hopping from one jurisdiction to another jurisdiction is difficult. And founders tend to be very much product centric and market centric, and they are not necessarily sort of like this global structure centric. And I
Yeah.
think that's sometimes where you find that the founder, which was good to bring a product into a market, make it the best product, etc., is not necessarily the best founder to take it
Mm.
global or take it into other markets.
No, no, no. And then in South Africa, the other problem is then where do you raise the money from? Like there's hardly any Series A, Series B rounds here, right? So you must go abroad in a way.
Yeah, it's quite difficult. Even for Series A, Series B, those VCs still want to have, ideally, the core leading team
Mm.
on their doorstep, because they want to kick the tires. They want to be close. It's not like a private equity or a later stage type of investment where there's more, capability. So what is then required is the founder, and that's what we needed to do from the Israeli investments, for instance. You actually had to put a presence in the environment where those other monies will be available, so that whoever invests feels it's on their doorstep and they can connect with a person, at least, in the same time zone and so forth. Fortunately, with COVID, Zoom made it much easier to invest over distance, or, this video, there was much more of an acceptance of people working from different environments and so forth. So that it had a change. But still, by and large, it's it's very hard if you want to court investment in Silicon Valley or in Texas or in Florida, let's say in South Africa. You have a material disadvantage that the other startups, they are there at the evening gala events or, cocktail events, etc., and they start building relationships with these managers, and there is that sort of like familiarity which is in their favor when it comes to that VC manager taking decisions. So, if you work with someone which is on the doorstep and quite well, yeah, maybe it's not as sexy as that company in Africa, but
Yeah.
at least you know what you have. So it's difficult for the people in Africa, and that's where you have to rely sometimes on your existing investors to hopefully have a relationship with investors in these other areas, and where the other investors trust this investor and therefore come in based on the trust, not on the startup, but on the investment layer.
Oh, yeah. Yeah, true. Yeah. Yeah. So founders here in South Africa, like at the moment, as you also pointed out before, like the structural challenges that, the funds are now coming to an end, and like there's limited liquidity and exits in South Africa. So and last time when we talked, you also talked about the lack of secondary markets, which is much more common in the US. So I'm wondering, like, because you said like you saw other markets at a similar stage. So what were like the possible um
Yeah.
like avenues from that point?
Yeah, so I think it is a little bit the Gartner disillusionment curve, or whatever you want to call it.
Yeah.
The where you go through the hype and then there's some sort of market correction happen. I think my sense is that COVID actually also helped the hype, or increased the intensity of the hype, because there was a lot of VC activity during COVID in that time, and then you had all the impact funds coming into Africa. And Africa is a very interesting environment. But it brought other pressures. It had brought money into the market where the discipline and the pressure on the individuals, on the founders, were not there to just focus on the best product, the best market. They had a lot of other requirements to meet as well. And if you talk about that in general in South Africa, because we had now this huge rise of number of funds starting from 2010 onwards, all of
Right.
these, which now have to start from 2020 onwards, had to start thinking about liquidating these funds. You
Yeah.
have the pressure that they sit with these shares in these portfolio companies, which they have to sell. Now, if that's where you need a secondary market. Now, the problem with the secondary market is, if you have enough secondary monies available, it's fine, because then what you have is you have these funds coming in and they will buy a block of secondaries and put a primary investment in the company significantly. And it's almost on a continued path. There may be a little bit of a lowering, but if you talk about companies in distress where the valuations is really going much lower, almost by definition, it means no one will take a lower valuation unless there's stress. There has to be stress. Otherwise, you will just want to keep on growing your value of your company.
Yes.
So what you then start seeing is the issues that needs to be navigated by the founders are different. And that's where I see a lot of lack of experience in the African and South African VC environment, where you have to know how to help founders in those environments, because maybe many of these VC funds are also feeling the stress themselves, where they are in the process. So
Yeah.
secondary funds could be just another later stage or a late cycle thing. And I think there will be some opportunities like that in Africa as well. It's certainly. But my feeling is, if you have, like, for instance, in South Africa, if I can't remember the number, but if you look at how many hundreds of companies needs to exit in the next few years to enable those funds which are coming to the end of their life to liquidate their holdings, there has to
Yeah.
be a lot of pressure. And then you start finding that, and have a look at the DFIs, which are a big driver of investment in Africa. You can already see that their amount of new sort of like funds and investments has tapered off. So
Yeah.
there's certainly going to be less money supply in this environment going forward. So the founder will have to come to the conclusion, well, I just can't grow the same way that I've grown in the past and expect the money to be there.
Yeah.
I have to do some things different. And there has to be some changes in this process. And at the same token, you start now finding a situation where your employees have been with you for maybe 7, 8, 10 years. They also want to be part of the success story. They come to that fourth time of their life where they say, well, opportunity cost, should I go and do something else? You now have to, there's a different challenge in managing these people. A big problem when you go and raise primary capital is if you have a long legacy history, then people say, whereas I think the opportunity is exactly the opposite, whereas you can now go into these companies with an investment where there's a realization by the founder that I can't wait forever for the exit for my company. I have to
Yeah.
work towards an exit. And the next 2 to 3, 4 years, it's almost like a private equity investment. You put that last secondary check in. It's most likely on terms which is very advantageous, favorable for the investor, but also with a very clear focus on exit in a very short period of time, because that's what's going to drive that investment. So yeah, there's going to be some gear changes, some mindset changes. Not always. And I don't always talk about a distress situation. You might have a very good company, but it's the environment outside there. So you have to
Yeah.
just find different answers. Yeah. So I think that's what we're going to do more so than, for instance, if you think about Israel. What happened at the time, by 1997 in Israel, there was about 75 VC funds. Just to give you on a scale. At 1989, 1988, there was one. Just to give you a sort of like formal VC fund. And then there was actually a lot of secondary money coming into you had the sort of dot-com bubble as well, which were actually happening right at the end of that decade. So the same issues which you have or the issues that you have in African market is not necessarily the same that what you would see in other, at that stage, nascent, emerging, now more mature markets, VC markets. Yeah.
Yeah. Yeah.
So I think there's going to be an interesting time, and so as I told you, 40 Eyes, for instance, looking into now the raising of a very specific type of secondary fund,
Yeah.
which is not just buying secondaries, but it actually will do secondaries plus primary money, but also with a very clear package of support to those founders, which then, they will need it in that case.
Yeah. Because otherwise, when there's no secondary market, so basically the secondary markets, they're buying the shares of the LPs, so that basically there's some more liquidation happening. Is that correct?
There's two tiers of secondary market. So you have the secondary LP market where LPs buy out LPs. But
Okay.
actually on the portfolio company, there's also the secondary market where funds buy out the shares of other funds or buy out the shares of employees. So that's where the new money going in is not what's typically the requirement for the VC. When new money goes in, it has to be put into the company for growth. You'd never want to pay someone's debt or buy out shares. You want your money to add value to that
Yeah.
company. So
Yeah.
that's a typical VC fund. Now, a secondary fund is one where you have come to the resolve for this company to be successful. Some people have to be released from the company. You have to put some money with some employees, to keep the motivation there and buy some of their ESOP shares. You have
Mhm.
to, or founders,
Yeah.
some of the founders, you want them to focus. You don't want them to, you want them to be sufficiently well from a financial perspective that they can retain their focus on the company, but not too much money, because
Mm.
then they're not aligned with you anymore because they've made their money, and they're not. So you have to find that right sweet spot there, and then at the same token, take out some of those VCs which have no option then to liquidate and typically buy those shares at a discount,
Mm.
because they will have to sell at a discount at that time. So basically, you have the opportunity to come in at quite a late stage in that company at quite favorable valuation with a rather shorter time to exit.
Yeah.
But you have to also realize that comes with something else where you have a founder which can't be business as usual. It has to be somewhat different.
Mm. I see. Yeah. Yeah. And have you also seen like that's what I've realized or seen in Europe, that also PEs now are actually entering the same market earlier, especially when it comes to technology and AI, because they cannot wait that long anymore. Otherwise, it's obsolete in a way.
Yeah, that is true. So typically, I mean, usually in a regular environment, your exits for startups is always just, trade sales or buying by strategics or a listing going public. But there has always been the private equity market where this, because you've now matured from being a startup into a more a growth entity, and and then you have these private equity houses, some which specialize in areas. You will have some which specialize in financial or crypto, and some on agro, or different types of, or space or whatever. And they will do somewhat roll-ups, if you can call it, but it's not a typical roll-up where they integrate these things. But that's what we said at the outset, that some VCs developed a very specific expertise in an area. They have a sort of a Rolodex of people that can be appointed. They have a Rolodex of experts which they can, you know, bring into these companies to advise. They have really good contacts into that market environment, typically serviced by these entities. If you take, for instance, now what's a very hot area in the US is the space, and satellites and things like that. So I was just at a conference in Florida, maybe a month ago, and it was amazing for me to see how suddenly, where it was not even spoken about a year ago, suddenly it's just the theme, the name of the game. But then you actually see there are, so quite a few people quickly put the label on their firm, but they do not really have deep expertise. But there are some of them which do have real
Yeah.
deep expertise. And the private equity homes then actually will become, they will play a little bit VC on the one hand, but on the
Hmm.
other hand, the more larger private equity places become a valid exit for some of these startups. The interesting thing here, though, for African players, I have not yet seen that well developed
Mm.
transitional layer from the VC to the private equity environment. There are certainly examples of that, but it's not remotely as
Right.
strong, defined, proven exit tier for startups and for VCs.
Okay. Yeah. And maybe to kind of like close that picture a bit more for like a founder, like what is most important for a founder in South Africa to understand about the VC game? I mean, I've took some notes. Like it's kind of like to really understand like how the investors work, and like that at the moment there's kind of like a lack of exits or liquidation problems, so they have to think through like where they want to go and like how to set themselves up, but also being aware of the pressures in the system. I mean, about the
Yeah,
founder
I would, I
experience,
would
really too much.
yeah. My advice to these founders will be identify that one, maybe two investors in your investor mix which you can be closest with, and really develop that relationship deep, because you're going to need that. It's very, very helpful in this environment,
Yeah.
because when it comes to these difficult white waters, it will be good to have one or two of those investors to be very much pro whatever agenda, and use their advice, and listen to them in terms of rethinking your company strategy. It doesn't mean that it's a major change, but you will have to rethink the company a little bit. Sometimes
Yeah.
anyway, founders want to, because they're tired. I mean, they just depleted after so many years, and they do want to get,
Yeah.
see something else, something fresh. So it's not necessarily that difficult. But so that's one advice. The other one is, I would say, start early with cost cutting, because you will cost cut. I can tell you for sure.
Okay.
Now, the advantage of, there's this saying in the US, never waste a good crisis. So there is an advantage if you have no option but to
Yeah.
cut, because then everyone understands if you let people go. The problem is if you do it ahead of the curve, which you should, it requires much more resolve, because now people say, but we're still okay. Why do you let people go? Or why do you actually shrink things and so forth? Because it's not an absolute necessity yet. But
Yeah.
if you then go and you just look at how much more you can stretch your runway, and how much more you can, and often you need more people to evolve the product in the early days.
Yeah.
And as you move into commercialization, it's more tweaking the product. Of course, you always want to keep on innovate somewhat, but the intensity of innovation versus the total business is not
Yeah.
remotely what it was. So there's some people which was very important for you in the early days, which ain't that important in the later days.
Yeah.
And therefore, my advice is just be ahead of the curve. And because cost is going to be a critical thing as you go down the thing. The second thing is, if you talk about the change in, because you're going to have to double up your commercialization, you have to double the speed of commercialization. Uh, there's a lot of focus on tweaking the product and presenting the product. So it's more sometimes, you know, coloring and debugging, if I may use the words, as opposed to fundamental creation. And the types
Yeah.
of people that you need for that might be somewhat different. And the typical founder instinct, unfortunately, is still to use the person which create the product later on to also do that. And it's amazing. Sometimes it can be counterproductive, because you almost try to bring someone in with a fresh mindset
Yeah.
when they look at these things, as opposed to some of those. So there's a lot of things that you can do at this point in time,
Yeah.
which is actually good things for commercialization as well. But remember, you're going to be on commercialization on steroids. Once you reach this phase, it's going to
Yeah.
be just heavy. So
Yeah.
think about that ahead of time. Don't be starry eyed, and don't. I mean, what typically founders will do is they will then at that stage say, well, we have this company which could potentially acquire us, and that company potentially acquire us. So we should be careful not to, do anything changes now to change the momentum, because if the momentum is not good, we're going to lose value. We're not going to do good, acquisitions. And then you keep pushing it until you start seeing that those deals don't happen as fast as you thought it would happen. And now you have really burned a lot of money, and you are more with your back against the wall. And, how do you negotiate now? I mean, it's much more difficult for you to negotiate. So I think that that's one of the best. Stay close to in
Investor.
one or two best investors, and do start thinking about cost cutting and changing the mix of your team a bit prematurely. I mean, before you get to that situation.
And you also mentioned one thing in the beginning, maybe to know if you're playing the local game or if you're playing the international one. I think that's also quite a bit that kind of decides like how you probably structure yourself and like what relationships you should focus on. or not, etc. Yeah.
Yeah, it's particularly issue in Africa because Africa governments tend to be a little bit more prescriptive and involved in transactions.
Yeah.
So if you many of this actually means that there's some structuring required as well, and the
Yeah.
structuring has to be done smartly within the regulations of those different jurisdictions, because
Mm.
now you want to position the company for international growth. And this I mean, you can still have a company in South Africa and grow it international and exit and have a good exit. There's some good examples of that. But there are, of course, then these geopolitical concerns as well coming in, where people say, "Listen, well, I have to. I'm not 100% sure how this country is going to sort of navigate going forward, and I don't want to. There's foreign exchange risk involved in these investments, and therefore you may want to look at other structures. And as soon as you start looking into other structures, now there's a certain amount of your energy now also going into that as opposed to driving the business. And, what is a balance? Do you have the right people to do that? So there are other, considerations beyond what I've mentioned to you before when you set up business development and suddenly go from a low cost environment, which typically Africa is, and expand your business in a high cost environment. So now the question is, how do you deal sometimes with the same employee in South Africa, in Cape Town, earning X, an equivalent employee in Boston earning 5X or 4X, and they got to know about it. And once they listen,
Mm-hmm.
why I'm doing the same and that person gets so much more than I do? How do you manage that tension? It's
Yeah.
not trivial to manage that tension either. So there's some very interesting dynamics. It was less of an issue, for instance, between Israel and the US because there was much more parity, although there was a difference, but there was more parity in salaries. Whereas I think between Africa and the US and Africa and Europe, sometimes the gap is much bigger.
It's massive. Yeah. Okay. Yeah.
Yeah.
Is there one more thing we haven't covered it about the South African market you think it's important to understand or to know? Or have you covered most of it?
Well, I mean, the South African market, if you think of it, it depends so much. I mean, it's not a large market. So from a
Mm.
VC point of view, you tend to invest into a more diverse set of opportunities. Generally
Mm.
speaking, Africa has good opportunities in the financial space because ironically, where you have gaps, and that's also in the trading space. You find that technology can step more full-featured into that space and it's easier adopting. And sometimes even on the health side and healthcare as well. Whereas in the more mature markets for new technologies to become really a replacement of establishment is more difficult, but you have those opportunities in Africa and where there's really just some big gaps that technology can solve. So I'm actually extremely excited actually with the opportunities there. If you find the right way of navigating them, the right way of funding them, there's certainly some good entrepreneurs there and skillful entrepreneurs. But the amount of issues that they need to navigate versus, and if I invest in someone here from Georgia Tech or Emory here in Atlanta, is totally different. These guys focus on the market, on the product, and they just drive it, etc. When you're a South African or an African entrepreneur, you have to think about a lot of other
Mm.
geopolitical, structural things. Even another important thing in South Africa, which beyond the government-related things or regulatory-related things, is the labor market.
Mm.
In South Africa, it's a little bit almost like I mean, I'm not sure which words you need to go. Just some experiences in the Netherlands, where there's so much protectiveness on employees
Yeah.
that to be nimble and to be quick to hire and fire is not possible. And in
Mm-hmm.
South Africa, the same thing. So
Yeah.
that actually could become a real sort of heavy Achilles heel, a big weight on you when you need to rapidly
Mm.
change. Suddenly now you have to maybe bring in a CPA firm or CA firm to manage the transition because of the company will have to be put into management. Because if you really look at the obligation to the employees, suddenly you can't just let them go. The total cost is going to be 3, 4, 5, 6 months of salary, and
Yeah.
you don't have the money. So what do? That's why, again, starting early is the right way to do, and let it go.
That's gonna,
And
yeah.
also, don't feel too bad if there are signals coming out, and there's always a worry when people start leaving a startup.
Yeah.
It's not necessarily such a bad thing, because when a person leaves at own will, it's much less issues than when you have to fire a person, in South
That's
Africa,
true.
for instance. So I think the people issues is also, you get the benefit of these two major benefits. You don't have the same pull on employees, even though these days through remote work, you can have people working for corporates in the US, etc. But it's still relatively less than having a company in Silicon Valley, where you'll just know there's so many other opportunities for that individual. And, to keep that individual is so hard, to do. So you
Yeah.
have that more protectionism in the South African environment, and you have the lower salary in the South African environment. But then to balance that out, you
Yeah.
have this issue that it's so much more difficult to hire and fire. So I think those are also relevant in South Africa. If you think of the macro environment, I still believe there's huge opportunity. Of course, AI is a big thing these days, and there's a lot of AI talent in South
Mm.
Africa. I can tell you, very good AI talent in South Africa. I think that element, if you really look at the sort of, I always wondered as a VC starting from the 80s when you were in the PC revolution, and then you had the
Mm.
internet revolution and the mobility revolution, the cloud computing revolution, and all those, and now the AI revolution. You see all these
Yeah.
revolutions,
And space.
and you see how and space and space. Then you say, well, I mean, we are invested in a space company in ex Stellenbosch, which
Yeah.
in its space is certainly one of the foremost in the world.
Well.
South Africa,
Mm.
so they are there. So this exciting opportunities, all I can say, I remain extremely excited about it. But I do at the same token say, listen, there's some changes going to happen on the VC environment and the VC world and the portfolio world in the next few years. And let's just buckle up for it and be prepared for it, and not let us not be disappointed and
Right.
disillusioned when it happened, because it's just the normal sort of like hype curve, where you now sort of like just get to a new equilibrium. And I think we're going to get there in good space.
Yeah.
Excited
No, I
about
think
that,
I
Jana.
think like everything you shared today is actually helping a lot of people now, a lot of founders now to really understand the game, to manage expectations, or to be more aware of the stressors and what's going to come here, and to understand the market a bit better.
Maybe a last point as we close, what I want to say is, I think it's known that this question for spray and spray and pray is not working on fundraising. You have to work the networks. There has to be warm introductions. You have to. It's still a people's game,
It is.
and you have to be very careful when you go out in the marketplace, what label you put on your company when you raise money, etc. Be measured. It's always you have to find that nice balance of not over push it into the market, because there might be a immune reaction back to you. But at the same token, get out of your chair and get into the market and find those investors which you want to go, because you're going to need them. You know, one worry is that people tend to get too comfortable with behind the computers and Zoom, like we talk right now.
Yeah.
There's value in shaking people's hands and
No, massive.
looking them into the face. Yeah.
No, massive, massive. No. Thank you so much. Is there something the community can do for you, or for the A, or for your own startup? Is there something that would be helpful for you?
Well, I mean, I hope that we can get this the 40i fund closed. The next fund, this very specialty secondary
Yep.
fund, closed this year. And of course, we are engaged now with some LPs, and you know, it's always good to have 40i's message out. I think 40i's reputation is quite well known.
Yeah.
As I think that's how you got to me. So I think for us, it's just we have to now execute for the next phase and get ready for the next phase. We're of course working on realizing some of our existing investments, like it's expected to do, and fortunately, there are some of them which seems to have now the right stage, and we are engaged in some exit explorations with them. So yeah, so I think it's always good to have friends in all different angles. So Jana, whenever you meet with people, tell them
Yeah.
about 40i.
I will do that. Thank you so much. Thanks for listening. Hit subscribe so you don't miss the next episode.